Hey guys, so today we're going to learn about CCI. This indicator was created in 1980 by a gentleman called Donald Lambert. Now this indicator is used widely to measure momentum in securities such as Forex, stocks and options. The way it measures momentum is by measuring the current price level relative to an average price level over a given period of time. What the market believes is that over a period of time, a security will become oversold or overbought, and we use CCI indicator to identify these time periods. So let's have a look at an example how we can use the CCI to take a trade. Well, first of all, let me explain how the CCI works. The CCI has three lines. The top line is 100 positive, the bottom line is 100 negative, and the line in the middle is the sub-zero line. Now the indicator fluctuates above and below the zero line. If the indicator is above the 100 line, so above the positive 100 line, it indicates that the market is overbought. If the indicator is below negative 100 line, it indicates that the market is oversold. Now there are a number of strategies that we can use to trade with the CCI indicator. The two strategies that I want to talk about today is one, the momentum trading strategy, and the second, the reversal trading strategy. So let's start with the momentum trading strategy. The momentum trading strategy is when the CCI crosses above the 100 positive line. So in other words, when it crosses above this red line. This indicates that the buying signal for a trend up. So in other words, what this is indicating is that the market should be bought because it's strengthening. So let me show you an example. So as we can see that here the market was trending up, and also the indicator was showing us that it's above the 100 positive line. So we should be looking to join this upward momentum. Now the way we do this is by entering once we have a signal. That signal is whenever the line on the indicator crosses above the 100 line. So to clarify, we had the indicator above the 100 line, we had a upward move in the market, we then get a pullback, which is this down here. The indicator is now showing us that it's picking up momentum to the upside again, and so is the market. However, the momentum on the indicator is a lot more than in the market. So what we do is we wait for this line to cross above the 100 period line, and once the indicator crosses this line, which is here, this area here, we join the momentum. So we buy the euro dollar, and then we hold until the CCI crosses the zero line. So the entry is when it crosses the positive 100 line, and the exit is when it crosses back below the zero line. So you would have entered here, and then your exit would have been here, and you should have caught the move from there up to there, which is about 200 pips. Now, just in case you didn't understand that, let me give you another example. So we can see this market has been trending up. So it's making higher highs and higher lows. So the market is trending up. So what we need to do is trying to join this momentum to the upside. The way we can do that is by using the indicator again. As we can see that the market went up and then it pulled back here. And all we needed to do was look out on our indicator when the market crossed the above line, which is the positive 100 line, and then look for a buy entry based on support and resistance or supply and demand. So if we look at this move here, as we can see, the market was trending up, and then it had a pullback. Okay, and also the indicator pulled back. Now, when the indicator line goes above 100, we get long, and this is where it went above 100, and this should have been your entry point to get long. Another confluence that was there was that it was breaking above this resistance area. And then our exit would have been when the CCI crossed back below the zero line, which is down here. So your exit would be there. So you would have caught the move from there up to there, which is about 150 to 200 pips. Now that's strategy 1. That's momentum trading. Strategy 2 is based on the reversal signal. The way we use strategy 2 is simply by looking at the market and then looking at the indicator to see when the market is overbought or oversold. So to give you an illustration, if we look at the indicator here, we can see that the market is oversold. So what we were looking for is to buy the market once it starts reversing. The signal to get long here would be when the indicator line crosses above zero. So in other words, this is showing us that the market is dropping, but we're going to have a reversal. That reversal will usually take place when the indicator crosses the zero line. So once it crosses the zero line, we have an indication to get long. And as you can see, the market trended up. The way you exit the trade is when the market crosses above the 100 and starts crossing back below 100. So in other words, when it started crossing below 100 over here, that should have been your exit point. It depends what type of trader you are. Some people like to take profit soon as it hits the above 100 line. Others like to wait for it to cross below zero, because sometimes the momentum just picks up and you might have caught the bottom of the market or the top of the market. Some of the things you need to take into account when using the CCI is always trade in line with the trend. That way you'll be right 75% of the time or more. If you trade against the trend, although your trade might work on a smaller time frame or shorter time frame, you won't catch a big move. Now, the way you could have traded the euro dollar over the last few days or last few weeks is like this. We can see that the euro dollar is in a down move. Okay, so we needed to wait for the euro dollar to be overbought again, and as you can see here, the euro dollar gets overbought, and all we needed to do was short the euro dollar once it crosses the zero line. So as you can see, the zero line's here, so you should have shorted the euro dollar at this point, this level here, and then you would stay in that trade until the CCI comes back and crosses the zero line. That way you would have caught the move down and you would still be in that trade. Hopefully this explains how a CCI works. Remember, always trade in line with the trend. Never use the CCI on its own. So in other words, use it with support and resistance, supply and demand, and with the trend. The CCI is an indicator, so always remember that it will only give you an indication as to which way the market's going to go. You should do rest of your research based on price action and then use the indicator as a signal to take the trade.